Hi there, how are you? Welcome back to M Talks. Let's continue to look at some of the best investment options available to us to grow our money. We saw how volatile the stock markets normally are and how unpredictable they are as well. So it necessitates a large volume of funds to be able to work the stock market favorably. And that's an option that today the mutual funds provide. The mutual funds are where the capital is collected from a lot of small investors, which gives which sets up a huge capital for investment companies to actually work the stock market to the benefit of the investors. Talking about stock markets, today I see a lot of commercials, inspiring youngsters to get into the stock market and talking about how stock markets are for everyone and how it's not a rocket science, so it's not a big deal, and so on and so forth. But let's keep in mind one thing. There is only one player who consistently makes money from the stock market. Only one set of people, which are the stockbroking app companies and the people who provide the stockbroking terminals. They make commissions whether you buy or sell, whether you make money or lose money, they make commissions. But for the rest of us, it's still a dicey game. So, the best way, the safest way to look at or work the stock market is to work with a player who has a bigger number, which is the mutual fund companies. Mutual funds, by the way, as a concept, are not new. They are like hundreds of years old. The first mutual fund concept, I think, was created by a Dutch businessman called Abraham van Ketwich. He created a fund to invest in foreign bonds and plantations in the West Indies. And his concept was unity creates strength, which was a fantastic concept. And in fact, he offered this fund to small investors, people with not too much of money at their disposal, and gave them an opportunity to participate in, what should I say, growing markets, growing segments, things that they independently would not have looked at all. So this concept grew and people really took a liking to it, and a lot of people invested in this kind of activity, this kind of a fund. So he had more and more funds, and some of his funds apparently lasted for more than 100 years, 114 years to be precise. And it spread all across Europe, and it spread to England as well. You can't keep Brits away from the money. So the first official actual investment fund was called the Foreign and Colonization Trust. It was formed in 1868 by the British, basically to create funds to invest in colonies or create more colonies or whatever it is that they wanted to do at that point in time. And apparently that fund is, or that trust is, still being quoted in the London Stock Exchange. It's still existing after so many years. Anyhow, moving on. So the mutual fund as a concept, to empower the small investors, started picking up a lot of momentum. And in a capitalist economy like the US, it really gained a lot of popularity, and there were a lot of funds which, those days, most of them were closed-ended funds, which means once the new fund offer was over, nobody can invest in it. But today, most of the mutual funds are open-ended, which means you can continue to keep investing in an existing fund. So then it grew big time in the US, and it actually started the concept, getting popular across the third world countries and across a lot of economies. In fact, they say that the number of mutual fund companies are growing at a rate that they will outgrow the number of stocks that they invest in, over a period of time, because the growth of actual physical stocks is only X percentage, but the number of mutual companies are growing so much that over a period of time, the stocks that are traded will be so limited and so many mutual fund companies will be vying for them that the stock value will have absolutely no correlation with the performance of a company, or performance of the company in which, in the stocks of the company in which the mutual funds invested, if you get what I'm saying. So that's the kind of growth the mutual fund sector has experienced, is continuing to experience. So let's look at what it means to us. What are the benefits it brings to the table for small investors or sporadic investors like us? One, it gives us the benefit of large volume investment, which means that together as a capital of which our investment is a part, the total quantum of the fund can actually influence the market, can work the market to our advantage. Because, see, the stock market is a volume game. Unless you have a sizable component invested, it's not going to have a major impact on the market or on the prices or to work to the benefit of a particular investor. So, that the mutual fund provides. The second thing is the mutual funds, because of their size, are able to hire skilled professionals, skilled fund managers who watch the stock market closely, who understand the nuances, who understand the trends, and they actually make sure that this skill is used to the benefit of the small investor. That's a very big advantage that individual investors cannot afford because it's expensive. The third thing is that we, even as small investors, can actually watch what happens to our stock, the net asset value or the NAV as they call it today. We can keep track of it on a daily basis because these inputs are provided to us mostly online, so we can keep track of how our investment is performing. So which is a very good thing. And the fourth thing is it is liquid, it is largely liquid. If you choose the right type of fund, you will be able to get your money back as and when you want. I mean, of course, there are some funds where there are lock-in periods and so on and so forth. It of course depends on your choice, but it is essentially not blocked as in, like, a real estate or that kind of investment where getting out of it involves a lot of effort. So these are major pluses for the mutual funds. Let's look at some of the things that are not too convenient. I would say, I wouldn't call it a disadvantage, but not too convenient. One is, today, if you look at today the mutual fund market, there are too many options, too many confusing options. See, the mutual fund companies, in their what should I say, interest of providing some sort of a specific fund for a specific group of people, which means they profile people and say, okay, for this income category, for this age category, let's create a fund because this is what their profile is, this is what they will look at. So they keep creating these funds, which makes it very confusing for the investor to pick the right fund, to understand if this is the one that we want to go with, becomes a very difficult choice because each mutual fund company has got in their portfolio like hundreds of different funds: large cap, mid cap, small cap, arbitrage, dividend, equity, dividend growth, and equity growth. The options are very confusing. That I would think is something which is not very conducive for investment. The second thing is that, since most of this is driven by the stock market and the mutual funds, as a policy, they diversify their investment, they invest in so many different stocks. Keeping track of these financials is a tricky job, and it sometimes we don't understand. If you really want to go down and to figure out in your portfolio how much exact, I mean, how much money each stock has made, it's very difficult. So that goes on to the other side, which is the actual, what should I say, costs involved. For example, your entry loads, your exit loads, and your asset under management costs and all that stuff is normally not very clear. That's a big, for a layman, for a small investor, for a first time investor, or for a what should I say, somebody who invests more, like uh, without knowing or without understanding, it's a tricky subject. And some mutual fund companies actually take advantage of this, which is not correct, but it does happen. It is confusing. So this, by and large, is the issue with the mutual fund option. Moving on, what are the things that you need to consider before you invest in a mutual fund? First is to pick the right fund. Now, what you need to think about, what you want your money to do for you, or what you want to do with your money. Do you want to lock it in for a long period of time? Do you want it to be liquid? Do you want maximum returns? You have to figure out how you want your money to work for you. Based on that, you choose the right investment option or the right mutual fund in this case. Second is understand the charges. Please write them down before you go ahead and sign up for a particular mutual fund investment, because there are entry loads. When you buy, there are entry loads. When you sell, some companies charge exit loads. And then there is this, like I mentioned, asset under management charges. And then there are service charges, and then there are some documentation charges. A lot of them do charge, a lot of them, some of them don't charge. But it's a good idea to understand these charges so we know the kind of expense that we have to incur, or how much money from our margins of profit that we make or gains that we make is going to go away through these charges. And then, of course, the tax component. If your capital that you've invested grows or gains in value, it would attract a capital gains tax. And that's applicable in most countries. So please understand the quantum and see how to work with it. Having said all this, again, I would like to reiterate, as an investment option, if you're looking at working the stock market, which is still by and large a very lucrative, a positive option, because there is huge amount of money in the stock market, and there is a possibility that you can actually benefit from it. And the only way to do it would be to look at, or the best way, the relatively safest way to look at it is through a mutual fund option. So it's highly recommended. It's very popular and something that we can look at as a serious investment choice. I hope I have been able to make things articulated clearly for you. And if you do have any doubts, like I keep mentioning, write into me. I'll be very happy to provide whatever inputs I have. And if I don't, I will get them for you. In the meanwhile, thanks for listening to me. Stay safe, stay healthy, stay happy. Bye for now.